Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. And in the latest edition of Cats and Coins, I noticed that some ETFs and ETNs are closing.
They're closing, but yet assets overall in the space, they're growing.
That's absolutely right. In fact, we're at almost $10 trillion in global ETF assets. Let's get to the main headlines in the industry. Today, we mark the 20th birthday of the Invesco S&P 500 Equal Weight ETF. We're going to be talking to John Hoffman, head of ETFs for the firm, in just a moment.
Plus, it appears the reports of mutual funds demise were greatly exaggerated. We're going to show you a dramatic shift in flows compared to ETFs.
And we're going to take a closer look into an ETF invested solely in companies that are run by female CEOs, including Citi's Jane Fraser.
And as always, before we get there, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's taking a look at the flows. Eric, what do you got?
Katie, Matt, thank you very much. I read on Bloomberg News today a term, divided market, and I think I'm going to use it to summarize the flows over the past week, even 2 weeks. At the top here, you got XLF. That's interesting. That's that bank trade, right? People who ran in and bought banks after SVB have done pretty well. So we've seen a lot of flows there. And then you've got treasuries. Again, treasuries, but right below, you've got two S&P 500 ETFs. I think those really summarize the divided market that we've seen. And if you look at the market, it's up one day, down the next. There's a sort of a tug of war going on. Let's look at the outflows. And you do see the Qs and SPY at top, but it's not a ton of money. This money, it's like, there's like hotels that come in and out, but you'd like to see inflows there. This is the trading crowd, LQD as well, but then you've got tips on there, outflows from energy. And what I don't see, and what is interesting to me, is anything from value and growth. Remember, that was really on the leaderboard lately. So I want to go and check out the smart beta ETF flows over the past couple months. They can be leading indicators to where the market might go. So we look up here, growth. Okay. Took in money in March and in April. That's pretty good, right? You want to see money into growth. The next one down is value. A ton coming out of value. Is that trade dead, or is it just a little bit of a setback? I don't know. We'll find out. Quality, though, everybody likes this. 8 billion, 2 billion, 10 billion of quality is ridiculous because it's not even that big of a category. All this negativity here is ESG. Rough scene over there, and probably will continue to be. So, Matt, Katie, look, the flows into growth are good. But I could see value coming right back. Again, tug of war is probably the perfect phrase to put on the market right now.
Well, you're talking about smart beta. Let's talk to a guy at the company responsible for the first smart beta ETF. John Hoffman joins us now, head of America's ETFs and index strategies at Invesco, and RSP, of course, is the birthday boy that we're talking about today. Tell us about smart beta, this product, and the products that it spawned for Invesco.
It absolutely did spawn the birth of smart beta as a category of investing. So we're celebrating the 20-year anniversary today of RSP, which broke the link between the size of a company and the weighting in the portfolio. And so now after 20 years, we can look back at the performance there. It's outperformed 99% of active managers in the large cap core space. It's also outperformed the cap weighted capacity during that time period. And so when you break the link between the size of a company and its weighting in a portfolio, you inherently tilt to a value and a size factor. You also reduce the concentration risk, so you have less dependence on the mega cap names, and that strategy has worked over the last 20 years, and as Eric pointed out, has spawned an entire industry of smart beta investing.
So 2 points. Number one, I think birthday is a little bit cuter than anniversary. It's a little bit more human there. So that's my one pushback. Number two is, to your point, this has worked over the past 20 years. It feels like in the last decade, though, that really it's the mega cap, those weights that have really come into vogue when you think about the S&P 500, when you think about the NASDAQ 100.
They provided all the returns this year.
Exactly. It's those handful of names that have been powering this entire market. So what is the ideal environment for equal weighting? What is the perfect bull case for a fund like this?
Sure. So I think the idea of separating index or company size and weight fundamentally changes the return pattern. And again, over a long market cycle, what we've seen is that it does add value. There are periods, year to date, RSP is underperforming its cap-weighted peer. Flashback to coming out of the COVID crisis, and a more equal, diversified approach provided a better return pattern. So at Invesco, we believe in long-term investing, and this particular strategy really plays on the nuance of long-term investing, whereby you don't have that overexposure to the mega caps. Let's not forget, when the mega caps, do turn backwards, it's 27% of the cap-weighted approach versus 2.3% in an equal-weighted approach. So it's spreading the risk a little bit better. It's winning by not losing is how I like to say it.
When I tweet about RSP, some of the geniuses will reply with, well, it's just mid-cap. Just buy MDY or VU, get the same return stream, because once you get below the mega caps, you're all in that kind of mid-cappy space. What would be your response to that?
So it's a large cap core portfolio by definition from a style perspective. It does tilt more toward the small size factor. It does tilt more toward value. So it is not necessarily a mid cap or a small cap fund. It's the same components as the S&P 500, the exact same 500 securities, just reweighted using that equal weight approach.
And so, I mean, something about smart beta, I always sort of struggle because RSP, you could consider that smart beta, but then, I mean, the list that Eric showed, it really covers a broad swath of different factors here. You have growth, value, dividend, low volatility, momentum, et cetera. I mean, it's just so broad of a category. Is there any one sort of denominator that ties this together?
The most simplified response would be breaking the link between cap weighting and any other factor, whether you use a rule, as you pointed out, growth, value, momentum, a factor to assign the securities and the weights in the portfolio, that turns into a smart beta construct. And I think that what's really interesting is we're 20 years into this, but the growth is really accelerating right now. The last 3 years, we've seen a CAGR in the smart beta space of nearly 26%. So this ability to deliver very precise returns to manage risk more precisely, that is certainly in favor, and I think this market's actually just getting started around smart beta.
We were talking about the size of the industry is growing tremendously. We're about to hit $10 trillion in assets globally in ETFs. Why do you think that is, and does it continue at this pace?
I think it does. You look at this, you say we're 30 years into this market, 20 years into smart beta. It should be at maturity. The reality is it's nowhere near that. We're at $7 trillion here in the U.S. That growth is going to continue to accelerate. We think it's going to go through $15 trillion over the next 3 to 5 years. Why? ETFs are a tremendous delivery mechanism of investment returns. Whether you're packaging pure beta, smart beta, active management, it's the technology that is highly efficient, transparent, tax efficient, all the things that we know today. That's what's going to power the next 30 years of growth, and we think we're in the early innings.
When it comes to smart beta, one of the features that I like that's not really talked about much is the discipline rebalancing, right? This is a robot. It is going to go into the stocks whether the sentiment is good or not, right? And I like that robotic, emotionless aspect to these funds. That said, I do think they're active, right? They're just, I guess, rules-based active. Who are you really stealing assets from? We've talked about the growth. Is it from beta or from active discretionary managers?
I think, again, when you look at the market here, you've got single stocks, you've got single bond portfolios that are moving toward packaged products like exchange-traded funds, mutual funds, SMAs. We're seeing a significant amount of growth out of folks that don't want a single stock. They don't want a single bond position, moving to package capability. And so there's growth there. There's certainly a migration from high-fee, low-conviction active management to more systematic smart beta that has really changed the fee dynamic of the landscape and provided a really efficient way to get that investment return pattern. So I think it's a combination of all of that driving the growth.
And I want to talk a little bit about the ETF industry right now, because to Matt's point that you do see assets growing, it's coming as you start to see funds really close down at an accelerated pace. Specifically in the U.S., we've seen more than 60 ETFs close so far this year. I know that Invesco announced their own planned closures earlier this year. When you look across the lineup, do you see any more area for maybe some trimming there?
So again, I'm going to zoom out. $7 trillion market, 3,000 listings, going to $15 trillion.
$7 trillion in the U.S.
In the U.S., yes.
Yeah.
Going to $15 trillion in the U.S. Yeah. 3,000 listings. That is growth, right? When you have growth, you're going to see realignment as well. And to your point, we've announced liquidation of a certain number of capabilities this year. Many of those have been in the market for a long time. The average duration of those was 7 years in the market. Some of them actually go back 20 years. And so what we think is you're going to see capital continue to move to the high growth segments of the market. ETFs is very much one of those. Closures, liquidations have been in the ETF market for a long time. 20 years out from now, I'm sure we'll continue to see closures, but we'll see a much larger market.
I got to ask about where you're from. You're based in Chicago, but really you're from Wheaton, right? So I was out there last week, drove out to Wheaton, this little small town, Power Shares, First Trust, Innovator, Amplify. What is in the water there? Are they teaching ETFs in elementary schools or what?
You know, I think there's a real spirit, everywhere throughout this country of innovation and really thinking about things differently. And I can tell you in the early days of Smart Beta, the discussion was very much, is this active management? Is it passive management? What is it, Eric? Kind of to your point a moment ago. And the idea was, let's look at this as a delivery vehicle for bringing investment returns. It's very, very efficient. Now let's put a brain in the index. When you think about the first indexes, they go back over 120 years. They weren't designed to be investable. The Dow Jones Industrial Average, the S&P 500 is 1950s. These were not built to be investable. And so, Eric, to your question, what's in the water? I think there's a spirit of challenge and innovation, the idea that we can do better, the idea that we can go beyond average. And that's what really started our business and something that, from an ETF standpoint, something that stays with us today.
You could have learned that at Oxford. Went to college at Oxford.
There you go. No,
That's
I think
true.
it was
in Ohio.
True. That's
right?
true.
Correct. Good diligence.
The ETF asset per capita in Wheaton, though, is just off the charts. It deserves to be studied.
We got to go to Wheaton.
We need to get
should.
off the coast and into flyover country, because that's where it's all at. I'm telling you.
Absolutely.
John, thanks so much for joining us.
Thank you.
John Hoffman there of Invesco. Coming up, money market funds are dominating the U.S. fund landscape in 2023, causing a shift in the battle between mutual funds and ETFs. We'll talk about that next. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with triple leveraged bond funds. We're taking a look at TMF here. This is a direction fund that provides 3 times the exposure to long-dated treasuries. What's amazing to me is that if you look at this chart, it's on track for a 10th straight month of inflows. So if bonds weren't volatile enough, apparently there's a lot of love for TMF right now. Different story if you look over at the exchange-traded note business. We're talking about Barclays. The big news from last week is that they're shutting down 21 of their ETNs, not ETFs. They're exchange-traded notes. Of course, these come with a degree of credit risk, which we learned last year after Barclays' paperwork snafu. Now they're axing nearly half of the business. And let's also talk about mutual funds. Of course, this is an ETF show, but we know that money market funds have been in high demand. It's actually disrupting the leaderboard a little bit, Matt. When you think about the past few years, of course, ETFs have been crushing it, but just for the last quarter, we can see that mutual funds are making up ground.
Yeah, it does seem like they have certain advantages, maybe a little bit more expensive. Let's talk to James Seyfert about that right now. ETF analyst from Bloomberg Intelligence joining us here on set. So, James, it does look like at least some of this is driven by panic, right? Depositors taking money out of banks, and then all of a sudden they realize, wow, instead of 0.02% interest, I can earn 4.5%, in a money market fund. But the fees are pretty high.
Yeah, the fees there are not all of them. There are money market funds that offer low fees, but there are funds that are taking in billions and billions of dollars that are charging relatively high fees. So it's generating significant revenue for these guys. But as you mentioned, you look at Chase, they're offering 0.01%. But if you go, if you're looking at a mutual fund, your money market fund, I mean, those people moving money into the money market funds, they're not that disadvantaged. Yeah, they're paying higher fees to be precise, but I mean, they're not sitting in 0.01% savings accounts. The people moving their money there are smart enough. And like you said, it's probably a little bit of people, one, seeking rates, like higher interest rates, but it's also people fleeing what happened with Signature Valley Bank, Signature Bank, all those things. So money definitely poured out.
So a little bit of a double whammy there. Both people want to get out of banks and they're also searching for yield. But why hasn't that same impulse benefited ETFs to the same degree that we're seeing it with money market funds?
Yeah, so I think there's a push and a pull aspect to the money market fund flows, right? Money market funds, you talk to an average person, a lot of people have heard of them. They know what they are. They view them as sort of like savings accounts. So when they were taking money out of these bank accounts, they were looking and putting money into things like money market funds. They could go right to their brokerage. They could put money into a money market fund and get that yield right away. people generally they don't know about ultra short fixed income ETFs. The other part of it is
that's not like a common thing that people talk about.
Yeah, I don't think you're going to talk to somebody on the street and they're going to tell you, yeah, you should save 30 bips by putting your money into this ultra short
but there's
treasury
also a lot
ETF.
of functionality, right? You can't write a check from an ETF account, and money market funds you can actually use as a checking account, some of them, right?
Yeah, there are ways, there are a lot of benefits. And like if you look at an institution is never going to do this. They're not going to invest in a short-term, ultra-short ETF instead of doing a money market fund. A money market fund is viewed as a cash account. There's regulatory situations to that. And also there's same-day Fed wires. So like a lot of these money market funds, if you're an institution, you need money to come out of here, you can do things like say, hey, I need my money. You get to them before 12 p.m. or different cutoffs, and you get your money same day via Fed wire. So it's a little different. Like you would have to sell the ETF, and then you would have to take your money out of the brokerage account and move it wherever you need to move it. So there are benefits specifically for institutions. When you're retail, if you're looking at a retail client and they're looking at an ETF versus a money market fund, especially a high fee one, you might be better off with an ETF, but there's obviously trade-offs. There's pros and cons to everything.
And before we let you go, talk to us a little bit about the business from the issuer perspective, because as you guys talked about, fees are higher on these money market funds than they are on some of the similar ETFs.
Yeah, I mean, there are much higher fees in some of these funds.
Much higher?
Eric wrote about this. So there's money market funds out there charging over 50 basis points for these things.
Oh my God.
And they're taking in hundreds of billions of dollars. So they're raking in good revenue. The other part of it is like you look at the Fidelities, these other platforms, they're pushing people to those types of accounts. So you come in, you say, oh, here's an advertisement for earning 4+% in our money market fund, and people are just clicking that. And like I said, those people are still way better off than the people earning 0.01%. The national average for a savings account right now is under 50 basis points. So no matter how you look at it, most of these people moving the money to money market funds, they might not be as good as if they were really selective with their money market funds, but they're way better off than the average American.
Over 50 basis points.
Unbelievable.
As opposed to what on a short treasury?
5 basis points,
Okay,
if that.
okay. So it's a difference.
It's a difference.
Yeah.
It's a difference. James, this was awesome. That is James Seyfert of Bloomberg Intelligence. And still ahead, we're going to drill down into an ETF dedicated to women CEOs. We're going to do that with the CEO and founder of Hypatia Capital next. And if you just can't get enough of ETFs, a reminder that you can listen to Eric and Joel Weber on Trillions. It's their bi-weekly podcast that covers the industry. This is Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence. He's back with us for today's drill down, where we focus on one ETF. Eric, what do you got?
Today, Katie, we have the Hypatia Women CEO ETF. Pretty much it does what you think it does. It invests in stocks, companies that are run by female CEOs. There's over 100 of them, and it's actively managed. You can see here, 85 bips, a little on the high side, but with the lower stock count, it could outperform and catch some eyes. Let's look at the holdings here. Now, I was a little shocked. I was expecting to see the typical ESG kind of basket, but bam, right at the top, you've got 2 oil companies, not very ESG, which makes this fund interesting to me. It's way overweight industrials and way underweight tech. Again, not an ESG fund, even though you might think that based on some of the other ESG funds that were launched with women in the name. Now let's look at the tilts. This is a new function on Bloomberg called TLTS. I love it because it tells you the factor breakdown. And the big thing here, you see this is the big thing, this is size. This is going to give you a real big exposure to small and mid caps, right? So compared to the S&P, that's the big deal because it has to look through the whole market to get enough stocks to put in it. So again, small caps rally, this thing will probably rally with it. That's one thing you should know, but if they go down, this thing will probably go down with it. So Matt, Katie, interesting non-ESG thematic play. Again, probably going to need some performance to get some looks though.
Eric, thank you. And I'm thrilled to say that joining us to talk about this ETF is Patricia Lizarraga. She is founder and CEO and managing partner over at Hypatia Capital. Great to have you on set with us. Let's talk about that sort of philosophical debate that Eric led us to. Is this an ESG fund?
So, Katie, thanks for having me. And we did not position this as an ESG fund. We are a thematic stock. We are about investing in women CEOs. So that's what we do. We invest in all American companies that have a female CEO, small to mega cap. And the question is, why do we invest in women CEOs? And the reason Hypatia's investment thesis is that women CEOs will outperform. And so the question is, why will women outperform? And our investment thesis is that it's just harder for women to become CEOs, right? Today, in today's corporate environment, there's still a lot of obstacles. So the ones that make it, by definition, are extraordinary vis-a-vis the average.
All right, so I get that. I love that thesis. We just showed Jane Fraser and Vicky Holub. And why the makeup of these companies? Like, how do you choose? Eric pointed out 2 gigantic oil firms are at the top, and then it's not very tech heavy. Is that because there aren't very many tech CEOs? Safra Catz, obviously from Oracle, is in your fund as well. But is it just that there are more women CEOs in industrial companies?
So what we've actually tried to do is isolate the female factor. So we thought, okay, if we put all the female CEOs together, how do we make the returns of the fund be about the female CEOs? How do we eliminate other factors? So one of the things we did is make it equally weighted, right? So Oracle has the same allocation as Oil States International, and in addition, we made it industry neutral. So what we did is we took our benchmark index, which is the FT Wilshire Small Cap Index. As Eric pointed out, we have a lot of small cap stocks in there, and we made it industry neutral to that benchmark. So for example, if we have 120 stocks, but if we had 100 and energy was 6% of the index, but we only have 3 stocks, then we have to overweight them. That is why those 3 energy stocks are always at the top of our holdings, because there's less women in energy.
And just real quick, we have a chart showing the comparison between SHE, which I think this will be compared to, and WCEO in terms of tech and industrials exposure. You have half the tech it does. Does that mean that tech companies are run by men, but they put women on the board just to check the box? And what you're actually grabbing is more of the sort of female factor, if you will?
So what it really says is that there is, in the small cap index a smaller allocation to tech, right? Because if we have 12% tech, it's because the FT Wilshire Small Cap Stock Index has 12% tech. And then what we have to do in tech specifically is give each stock a little bit more weight, because there's, as you say, not enough women in tech to take it to that. So for example, Safra Catz, I think, is at 1.2% of the index.
Patricia, great having you in. Have to have you back. Patricia Lizarraga, running Hypatia Capital. That does it for Bloomberg ETF IQ. This is Bloomberg.